welcome everyone to the EIC Water webinar. I want to thank Justin Stolte, partner at Gibson Dunn and Crutcher and co-chair of the firm's energy practice. His practice focuses on acquisitions, divestitures, and joint ventures across the energy sector. He will be our moderator today for the panel. I also want to thank our panelists, Josh Adler, CEO of Sourcewater, Parker Lee, partner at Hunt and Andrews Kurth, Matt McGowan, senior counsel for Marathon Oil, and Jim Summers, CEO, H2O Midstream. We very much appreciate your participation. We are offering CLE credit today. Later in the programming, you will have a verbal code word. Please email me if you are seeking CLE credit with the code word, and I will send you the CLE certificate for this event. It's eligible for 1 hour. Now I'd like to turn it over to Justin to get this roundtable started. Thank you, Justin.
Well, thank you, Lori. Greetings, everyone. Thanks for joining us today. This should be a really interesting and exciting webcast. We've got a tremendous panel lined up, as Lori indicated. The panel comes from really all parts of the industry, which is by design. So on today's presentation, as part of the panel discussion, you'll be getting perspectives from all across the oil and gas space. And as you know, today's topic is, believe it or not, water. If someone told me 10 years ago that we'd be writing articles or doing webcasts or helping clients with produced and recycled water operations or transactions, I would have thought they were crazy. But water today is big business for the oil and gas industry, resulting out of really a marriage of necessity among upstream producers, oilfield service companies, midstream companies, and private equity firms, among many other industry players. Put simply, water is no longer viewed as a waste product or nuisance in the industry. It's viewed by most as a commodity. For purposes of this presentation, when we mention water, it is generally in the context of upstream oil and gas operations, either produced as part of the hydrocarbon mixture from oil and gas fields, or used for operations, upstream oil and gas operations, such as hydraulic fracturing. The agenda for today's presentation is as follows. So we'll give brief introductions. Lori's already done that. I'll tell you a little bit more about our distinguished panel. Then we'll set the scene with an overview of oilfield water markets to make sure that listeners who aren't that familiar with this space are a little bit oriented about what we're talking during today's presentation. We'll then spend the bulk of the time doing a roundtable discussion with the panelists. And while I'm listed as the moderator, really Parker Lee, a partner with Hunt and Andrews Kurth, he'll really be driving the show when it comes to that roundtable discussion. So he deserves a lot of praise for running that part of the webcast. And then we'll wrap up, and time permitting, we'll do Q&A. And so, you know, one additional house cleaning item, in addition to the CLE, we'll go ahead and give you the keyword halfway through the presentation. But as you have questions during the presentation, please submit them via the webcast software. We'll get to them more than likely at the end of the presentation, again, time permitting. If we don't have time, please reach out to any of us. We'll make sure that you have contact information to do so. So joining me today, as Lori's already somewhat introduced these folks, but as I mentioned, this is really a very impressive group of professionals that come from all parts of the industry. Josh Adler is founding CEO of Sourcewater Inc., which is a leading oilfield water intelligence platform that assists its clients in oilfield operations and investment decisions. Parker Lee, a partner at Hunt and Andrews Kurth, specializes in oil and gas transactions across all sectors of the industry and has spent a significant amount of time focusing on water transactions and commercial arrangements. Matt McGowan, who is an attorney with Marathon, is really well-versed on operations issues. He spent a significant amount of time doing it at Marathon, and in a prior life, I believe, Chevron. Spent a significant amount of time on oilfield operations. He's providing really the producer perspective and has dealt with many of the issues that we'll be discussing during today's presentation. And then finally, Jim Summers, CEO of H2O Midstream, which is a company that specializes in midstream water operations. Jim is recognized as an industry expert in water infrastructure. I'm now going to turn it over to Josh, who is going to set the scene for us.
Thanks, Justin. This is Josh Adler from Sourcewater, Houston. Fortunate to have an office that's right across the street from Gibson Dunn, so it's an easy commute. I'm going to talk about the evolution of oilfield water markets over the past 10 years. So I've been in this business about 7 years and have seen huge changes in the industry since really the early days in the rise of hydraulic fracturing. Today I'm going to be focused on the Permian Basin, which is about half the U.S. market, and there's no other basin that's more than 10%. So oilfield water markets are very, very different across different geographies. Some things are similar, but a lot is different. We learned that the hard way by starting in the Marcellus and then moving to the Permian a few years in and had to relearn everything all over again. But this will be mostly focused on the dynamics of the Permian because that's about half the U.S. market. So this chart shows historically the amount of water disposed of in the Permian going back about 40 years. And you can see it rises greatly in the last 10 years. But actually, this chart tells the story a lot better. If you see the blue baseline there, that's from conventional oil and gas production, whereas that green rocket ship taking off is water produced from unconventional. So we really are talking about a situation that is fundamentally new in the industry. We've been drilling for oil and gas in the Permian for 100 years, but water management as not just a big issue, but actually a majority of the total operating spend of any company that is producing unconventional oil onshore. That is a new issue that has only arisen in the last 10 years and really has not been understood as an issue until the last 3, maybe 4 years, essentially since the downturn that we had in 2015, 2016. Now, where most of that water goes today, over about 90% of it, is to disposal wells, saltwater disposals. And there's a better part of 7,000 saltwater disposals in the Permian. There's about 8,000 in Texas overall. The Permian, of course, overlaps into New Mexico some, so those aren't identical sets. And just as an example, if you look at Loving County, just Delaware Basin County, about 10 years ago had about 10 disposal wells. About a year ago had about 120 disposal wells. So a lot of new disposals are getting drilled. At the same time, if we just pick Loving County, again, just as a typical geographic area, you can see the amount of water being produced and disposed of has been steadily rising. But what's really interesting here is that just in the last couple of years, the pressure levels of those disposal wells has increased very sharply. And what that's an indication of is that those wells are getting full. And so the essence of this is that disposal capacity is not keeping up with saltwater production demand in many areas. And that is creating this market opportunity. Another way to look at that is to take a satellite image of just south of Odessa 3 years ago and then a few months ago. And what you'll see there is a lot of big frac pits that were not there 3 years ago. There's an enormous amount of development happening on the ground. And so in the early days of the industry, of the hydraulic fracturing industry, almost all water was moved in and out of the well site on trucks, typically 120 or 130 barrel trucks that look like this. And what's happened in that first kind of shale 1.0 period was nobody was tracking their costs. All we knew was that with energy prices up around $100 a barrel, there was a big margin to be made. It wasn't until the downturn that companies started realizing that the cost of producing a barrel of crude had more than doubled in unconventional versus conventional, and by far most of that cost increase was because of the introduction of water logistics as the primary cost in upstream energy production, and that did not exist before 2009. And so just to give you a little more sense of it, in the Permian in particular, in the Delaware Basin, the typical oil well produces anywhere from 7 to 10 barrels of water for every 1 barrel of crude. So if you're trucking that water to disposal and you're spending $1.50 for the hauling and 50 cents for the disposal, take that $2 per barrel of water, multiply that by 10, you're spending $20 per barrel of crude produced just to get rid of the water that came up with the crude. That's pretty tough to do if the price of oil is $40 or $50 a barrel. You're not going to have enough money to go around. What's happened is that most of the companies in the industry made the decision during the downturn to try to replace trucks with pipes because it greatly reduces your OPEX, because the cost of moving water in a pipe per barrel can be anywhere from, say, 10 cents to 50 cents fully amortized, whereas in a truck, it's more like bare minimum is going to be $1, but often it can be $2 or even more in some places. So what happened? In the downturn, we had companies with excess capital around. There wasn't much money to be made on drilling new wells. And so they put that capital to work by reducing their operating expenses by investing in water infrastructure. And so here's just one example, happens to be Halcon, but there are a million examples, not a million, but there's probably 500 examples like this, where companies touted that they were building water infrastructure, and this is from an investor report. If you zoom in here, they're showing that they reduced their cost per barrel of energy equivalent from $11, $12 a barrel for getting rid of water to more like $1.43 for getting rid of water. And they did that by building their own pipes and replacing trucks with pipes. The problem with that strategy is that you've now got lots of capital tied up. This is high risk, high return energy capital from your investors that is expected to be used to generate high return energy. Instead, what you've done is you've taken that capital and you've invested it in building empty, badly run water utilities. The water utility business is not famous for its high returns. And when it's a captive water utility used by only one company, and because this is very important, the water flows for any one company for any given location are highly variable. In the hydraulic fracturing process, you need a lot of water for a short time to frack. You then don't need any water for a while. You flow back a lot of water for a short time from the frack, and then you produce a modest amount of water continuously, but slightly diminishing for the entire life of the well. And so because of that, it's impossible to perfectly size your infrastructure capacity for any one company or any one location. You're always going to be long or short. These same problems happened in the oil and gas production industries historically, and so those turned into midstream industries, and that's what's happening now. Companies are trying to free up capital that was invested in building water utilities. They're selling off that water infrastructure to third-party companies that are in the business of being good at keeping pipes full. And so those companies, this happens to be Waterbridge, Halcon sold their infrastructure to. This happens to be a map of some of NGL systems, or this might be Mesquite. NGL then acquired Mesquite. These companies are now consolidating. And where we're going is having an industry that looks, in some ways, superficially, a lot like the crude and natural gas midstreams for a lot of the same reasons. We're going to have a modest number of large interlocking systems where capacity can be traded between them. But there's a big fundamental difference here between traditional gas and crude midstream and the water midstream. It's actually very different despite having pipes. And that's because supply and demand is very difficult to match up in the water space. And there's a number of reasons for that. One, the Permian is very large and very complex. There are millions of connections between different producing leases and disposal wells. And these pipelines, there's over 300,000 active wells. There's actually about 12 billion barrels of water produced in the Permian last year. About 1/3 of that goes to disposal. The Permian is also very complex in the subsurface. Most companies think that there's only 2 or 3 underground formations where water can be injected in the Midland and Delaware basins. In fact, in some places, there are 47 different subsurface formations that can take water, but they've never been mapped before. What I like to say is the geologists have been studying the Permian for 100 years to figure out where the hydrocarbons are and to get them out. But until now, nobody's been studying the Permian to figure out where to put the water back down. And so we're doing that by mapping all the 3D stratigraphy of all of these formations to figure out what is their pressure levels and capacities, and that helps with drilling as well because you have to drill through them. There's a lot of things that need to be understood about water dynamics subsurface. And then there's the timing element, which is extremely complex for the reasons of the variability of water coming in and out of the ground in the hydraulic fracturing and production process. And so what I would leave you with is this is all quite complex. And in fact, I would suggest that the water midstream business actually looks a lot more like the power grid and power markets than it does like traditional gas and crude midstream. The difference is what we have is a distribution system. It's short distances between many different sources and sinks that are constantly changing. So just like you might have a solar panel on your house, sometimes you're generating net power, sometimes you're consuming net power. All of these different producing lease and disposal locations are sometimes net producers and sometimes net consumers, and which ones are which are constantly changing all the time based on this demand. It's distribution, not transmission. It's not all coming from Midland going to the Gulf Coast. It's moving all around in different places between different companies. We're also dealing with a commodity that is usually a waste product, but is sometimes an input for energy generation, and which one it is always changing. And also, this is multi-directional and sometimes has a negative price and sometimes a positive price. So there's a lot of new legal and regulatory and economic issues to be dealt with in this emerging water midstream market. And that's what we're trying to help our clients understand by going along for this ride for the last 7 years. And I think it's going to continue to be a very interesting next 7 years. And with that, I'll hand over the mic.
Great. Thanks, Josh. This is Parker Lee. That was a great presentation. Very interesting. I think he does a great job of outlining the rise of the water industry and how quickly that's happened. Before we move into the topics we're going to go over in the roundtable discussion, I will impart some of the most valuable wisdom I'll provide today, and that is the CLE code, which that is water. Can thank Mr. Stolte for that creative code. So the CLE code, I'll repeat that again, that is water. I think Lori had mentioned if you want to seek CLE credit, you can email her with that code of water at the end of the presentation. We are going to tackle 3 different topics here during our discussion, a roundtable discussion. The first one is water midstream joint ventures. Joint venture arrangements have become fairly popular in the water space, and producers, as Josh mentioned, producers have numerous options to manage their water, but the most popular are self-management, building your own infrastructure, completely outsourcing that development to another company, usually a water midstream business, or a hybrid JV model, which seem to be more popular. We've seen some where you have a producer and a water midstream business create a new co and contribute water infrastructure and then rights to build water infrastructure into that new company, with the producer perhaps retaining some equity upside in that model. So we're going to talk a little bit about the pros and the cons to these different approaches for both the producer and the midstream provider. And then maybe we'll talk a little bit about some of the more innovative joint venture models that we're seeing in the market. And, one thing I'll mention, the title of this discussion is Water 2020, What's Next? So I think as we go through these topics, we're going to try and talk a little bit about where the market is now and where we each think the market might be moving in the next 12 to 18 months. So I'll start with Matt McGowan, since he's got insight from the producer perspective. Matt, do you want to talk a little bit about your thought about JVs, water management from?
Yeah, I think from the producer perspective, I can kind of give a high level of all of these and kind of some quick pros and cons. I think Josh did a really good job kind of quick hitting them in his presentation. And I take my perspective on it and go a little more in depth. I think there's a lot in common with the self-build model as well as the EMP JV. And you see that one where it's two EMP companies coming together to share an infrastructure. A lot of times that happens where they have a joint development, such as a large JO area or a more formalized joint development area, and they get together, and it's normally for a lack of need, that there's not already an established infrastructure with the capacity they're going to need, so that they build their own. And sometimes they sell it off, sometimes they maintain it. But you also see that with the self-build where the company owns everything themselves or they're the operator. And what this gives you is it gives you ultimate control. It gives you ultimate control over your timing, your costs, and your locations. But it also gives you 100% of the risk as well. I have had clients in the past, and I've been dealing with this particular water aspect for about 7 or 8 years. So I've kind of seen the industry mature from where we were just talking to drilling our own saltwater disposal wells on a rancher's land to what we have now, which is akin to more of a utility system, like Josh said. But I've seen companies come in and about to put a 6-well pad on, and they need a disposal well that can take on the water for the production that's going to come from there, and they drill a disposal well that doesn't perform the way they thought it was going to. It's just not taking near the quantity. And at that point, they're scrambling to find other decisions. And when you have no leverage, that's when the price gets really high. Where there is infrastructure in place or where it's worth it to have someone build out to you, outsourcing, I think, is the preferred method for a lot of companies because we are experts at getting hydrocarbons out of the ground. We are not experts at keeping pipes full and efficiently disposing of water. And as long as, the pain of doing it isn't too much being the cost, I think that's a preferred method for most producers. The last JV, which I think you're seeing more and more recently, and I think probably is what you've done more of, is the midstream/EMP JV. Yeah. And that's one where you have the producer who partners up with the midstream company to say, hey, we're going to do this in this area, and we're also going to invest in you. That's an interesting component from my perspective, because if you're an EMP company, what are you providing to this joint venture? Are you providing your own infrastructure in the terms of existing saltwater disposal wells or a rig that's dedicated to drilling saltwater disposal wells? Do you have existing pipes on the ground or ponds that you're lending to it, or are you just investing money? And if you're just investing money, my question to you is why? And what does that signal to the market? You said that you saw a lot of in the downturn companies were doing that. That was the company saying, look, we can't make money right now with these prices drilling wells, so we're going to do something else. So I think a lot of companies are very aware of that, and they don't want that question to be asked about them. And then, how much control is the producer going to have of that joint venture? Do you let the experts in the midstream take control, or does the company try and exert more control? And in that situation, do you end up with one company, and it can be either one, and at times it can switch, subsidizing the other company as far as costs and efficiencies go? Josh, have you seen a lot of that with these joint ventures that are coming together, or is it more letting the experts take control?
Most of these deals today are getting structured as acreage dedications, which, there's occasional guaranteed payment type contracts or minimum levels. As someone who my previous career was in the real estate industry, and I'm amazed that, the infrastructure companies are able to underwrite and finance large-scale construction projects off of the acreage dedication structure without having a guaranteed lease or a guaranteed income on it underwrite. That I had to hear that a few times before I said, really, that's how it happens? But it does. And what that means is that you're betting a lot of money on being good at predicting the future of energy markets. And then you're actually trying to predict the derivative of the future of the energy markets, which is the water market, because the water doesn't get produced unless the wells get drilled, and the wells don't get drilled unless the energy prices, make those wells make sense, and that's all supply and demand. One of the things, though, that I've heard that's interesting is this risk is not all risk on the water midstream or disposal company, because there really is still a big financial risk on the operator. I mean, the obvious one, of course, is that the midstream company just turns out to not be able to make it, and so they aren't able to provide that flow assurance long term because they were too aggressive in their contract. They aren't making enough money to keep the system operating. They took too much risk. But it goes the other way, too, which is for a lot of the, potentially over-levered operators out there for whom in today's financial markets, selling off their water infrastructure is about the only source of short-term cash that they have. And so there's a real risk that they are basically pulling forward the value of that water infrastructure by agreeing to rates that are above market rates or will be above market rates in the future for the per barrel amount of water that they end up producing. And so they're financing today at the expense of tomorrow, but they may have very high operating cost structures in the future if they agree to dollar figures to get that water system sold today that actually aren't going to be supportable in the future.
Yeah, that's a great point, Josh. And Jim, do you want to weigh in a little bit on this and kind of from the midstream water management side?
Yeah, absolutely. First, let me check you can hear me okay. I'm joining from Midland, Texas today, so kind of right in the heart of everything. You guys can hear okay?
Yep.
Yeah.
We got you.
Fantastic. Well, again, this is Jim Summers. I'm the CEO of H2O Midstream. I think Josh and Matt have done kind of a great job framing this. I think from our perspective, we are a private equity-backed water midstream company, which is a fairly new term. Myself and the team that started H2O Midstream about 3 years ago were all veterans of the gas midstream industry. So I started with Conoco in the 90s. The rest of the team as well, experience at Conoco, Pioneer, Mobil, Williams. Your listeners probably know most of the team. We grew up watching the evolution of the gas midstream market. In fact, nobody called it gas midstream back then. We were part of natural gas and gas products. And what we saw happen was when producers built those initial gas gathering systems, they were really to facilitate the movement of crude oil. The need to get crude oil to market, and as the gas markets evolved and as gas became a marketable commodity, those systems that were built to manage producers' gas volumes over time began to get empty. So the utilization rates from the peaks down to over time were such that you had available capacity. So within Conoco, we built an entire department to manage that white space and began going after third-party gas volumes. And so we really watched that entire midstream business evolve. Over time, what naturally occurred is the producers realized that it wasn't a core business for them. Many of them, they could monetize those assets. And really, that was the launch of the entire gas midstream industry as we know it today, as it's evolved over the last 30 years. So for us, we've kind of seen this before happening at a very rapid pace. As Josh described, you've got this evolution now of water as a rising commodity, the producers understanding the economics of putting water on pipeline versus trucks, and the need to build infrastructure. And so logically, it makes sense the producers would put that infrastructure in place to manage, especially in the higher price environment, to make sure they could get crude to market. So when we launched the company, we launched it under the premise that the most important thing we could do was gain the trust of the producer. Because ultimately, we felt that the ownership of those assets and the management of those assets would not be core to the producing community, and we would need to be able to manage them on their behalf. So sure enough, over the last couple of years, we've seen a lot of producers divest of those assets. We've acquired a couple of those systems in the Midland Basin from Encana, from Sabalo, and we've entered into a number of long-term acreage dedications. In fact, the first deal we did with Encana in 2017, we literally took a gas midstream acreage dedication, scratched out the word gas and put in the word water. That contract has evolved, but that really started for us, this acreage dedication, and you've seen that in the market. That's locking up at one extreme long-term, multiple-year contractual assurances for the producer. What's starting to happen now, and my take on sort of the joint venture model, is as larger and larger producers come out, especially in areas where there's minimum infrastructure. There's really two reasons why I think you would enter into a joint venture rather than more of a contractual acreage dedication. I think one is control, and that's probably the biggest reason that we hear, and we've been in several negotiations and are in several live negotiations over whether this is a contract or whether this is a joint venture with ownership. And the producer having that control primarily comes back to flow assurance. Can we provide contractually the assurance the producer needs such that they don't need to worry about when the well is going to be drilled, is the disposal well going to be effective? And so our response to that has been to build very large integrated networks with multiple disposal wells connected by pipe, with storage, with multiple outlets, to where we can provide and have provided close to 100% flow assurance. I think we're at 99.98% since inception, 100% year to date for that producer. So that's kind of the first question: can a midstream provide flow assurance? And the second reason would be if that organization wants to be in the midstream market. So just like on the gas midstream side, if it's an E&P that wants to participate, likes the upside, likes the risk profile, wants to put money into infrastructure, one way to participate is via a joint venture where they share in both the upside and the risk. So I'll kind of pause there, but that's my take on where we've come, what's happening. I think ultimately the evolution will look a lot like what's happening in gas midstream. You're going to see variations of different structures based on the flavor, based on the producer, their interest, the location. But I do think what underpins it is the trust and the ability to perform.
Yes, thank you, Jim. And I think one thing I'll mention, kind of on the joint venture aspect. We heard Matt talk a little bit about an E&P joint venture. Jim, you guys have a pretty unique situation in that you've got a water midstream, water management joint venture with your university lands project. You want to talk a little bit about that?
Yeah, that's a great point. So we have two platforms in the Permian. We have a Midland-based platform where we're 100% owner. We have the relationships with our 7 different producers are all contractual. So we manage that under a series of long-term contracts, mid-term contracts, and then spot arrangements. The second platform we have is in the Delaware Basin. And you're right, that is a different kind of a joint venture. And the evolution of that joint venture really came about where you have a very large landowner in the Delaware Basin, University Lands, really looking across their acreage in the Permian Basin and coming to the recognition that the best way to serve their producer community, the individuals that are drilling wells on their lands, is via a water midstream model. And their focus really was for those that are developing on university lands, how best can they manage water? How can they reduce cost? How can they provide flow assurance? All of the above, because ultimately their goal is the development of those lands and the mineral interest that will come with that development. So University Lands reached out for a partner. They said, look, this is not our core business, but we see the model evolving. We want to be a part of it. So we formed a joint venture. They actually reached out to all our peers. We went through a formal RFP process, and we formed a joint venture with one of our peers in the industry, Lane Water Midstream, which focus at the time was on the Sourcewater side. In fact, I'm in their offices here today in Midland. Our focus was on the produced water side, and we put a joint venture together with University Lands to cover what we call full cycle water midstream, the entire value chain. We've since added a third member to that joint venture, which is an investment group called Etimco, which manages University Lands investments and mineral interests. And then we actually have a contractual relationship, a 10-year rolling agreement with University Lands that provides sort of a unique set of advantages, pre-approved right-of-way, discounted rates across their land in the Permian Basin. So I think it's a good point, that's another kind of joint venture that could be done with the landowners, and in our case, with a midstream peer of ours, where we each brought different skill sets to the table to serve the community.
Yeah. Thank you, Jim. I think we could probably spend the rest of this entire webinar talking about this topic, but we do want to move on. And so I think we'll go ahead and move on to our second topic of the roundtable portion, which is water midstream trading markets. Do these trading markets exist now? What does the future look like? Certainly, other hydrocarbons commodities have developed trading markets. I don't know if people are as familiar with water trading markets. And so I'll actually kick it back over to Jim, who's got experience with managing trading desks, I think on the more traditional commodity side. Jim, do you have any thoughts on the current state of water trading markets and where they might head?
Yes, I think similar to what we saw, again, back to the evolution we saw on the gas midstream side, I think you're seeing some similar things happen on the water side. And I think what's been interesting for us is to see how quickly this has evolved. So I think when you talk about trading, I think that means a lot of different things to different people. But I think where you start is with the market. So we've used that term several times. What is the oilfield water market? What is the framework for that market? And Josh did a good job of describing the supply framework, where the water comes from, both the produced water and the source water, the demand for that water for hydraulic fracturing and potentially other markets in the future, and then what type of transactions are occurring. So let me kind of just start there. And very similar to gas, the transactions which have occurred primarily to date have been bilateral negotiated agreements. So if it's a long-term acreage dedication, that's what I would call a highly structured, again, if you kind of come from the energy world, you might call that an origination or origination structuring deal. Months, lots of nuances, bilateral. At the other end of the extreme, interestingly enough, could be a handshake deal with an operator in the field. So you're dealing with a very, very wide spectrum of types of transactions, and how do you paper that, and where's it going? I think the key ingredient here is infrastructure. As you've seen infrastructure get built out, and I can speak to our own system in the Midland Basin, we've added pipeline, we've added multiple producers, and most recently, we commissioned what has been dubbed the first, I guess you'd call it the truck-free pipe-connected hub in the state of Texas. Railroad Commission didn't really know how to permit it, but what it is a million-barrel storage facility that can be used by multiple producers. We're connected by 200 miles of pipe and a network of disposal. And what that hub does is it becomes sort of a precursor to the ability to trade on a more commoditized platform. So my take on this is you're moving from a bilateral negotiated contract framework to one where as standardization occurs, both around the commodity quality, whether it's a freshwater treated barrel to a particular specification or even raw produced water, you have a quality specification, and we're getting convergence around that. Now the key is, can you get the product to a specific location at a particular time? So if you think about natural gas or natural gas liquids, you have the Henry Hub, you have Mont Belvieu, you have Conway, you have specific traded hubs that are interconnected by pipe, interconnected by storage. As this market evolves and you get increased interconnectivity, in my opinion, you're going to see more and more what look like traditional trade platforms where you're able to manage risk, not only manage the underlying commodity risk, the price risk, but you start to do things like locational differentials, basis differentials. What does one hub to the next look like? As you add storage, you're able to manage forward time periods. You can put water in storage and take it out in the future, and even cross-commodity arbitrage, like you might between gas and power. So you have a spark spread today where you're converting gas into electricity. You might have I don't know what you'd call it, a wet spread where you convert, a dirty barrel into a clean barrel. So there's a lot of those kind of things happening. It just is a function, I think, of the infrastructure being put in place, and the market will follow.
This is Josh from Sourcewater. Jim and I have had plenty of conversations on these exact subjects, but I think winding back a little bit to 2012, when I first had the idea to start Sourcewater, that was actually really inspired by the need for water recycling markets in the Marcellus Shale in Pennsylvania. And we originally created Sourcewater as an online marketplace for water trading and recycling in the oil and gas industry, and the kind of like Airbnb for water, if you will. The focus there was the Marcellus, and the reason was that in Pennsylvania, there's only about 8 commercial disposal wells. And so if you're unable to reuse your produced water, not really your produced water, but your flow back locally, you've got to put it on trucks, because there are no water pipelines there for a whole bunch of reasons, and haul that water to Ohio, and you can end up spending as much as $20 per barrel of water to haul and dispose the water. And certainly the $8 to $12 range is common. So compare that to $1.50 to $2 in the Permian by truck and 50 cents to $1 by pipe. So this is really a life or death issue for operators in the Marcellus. And that is why recycling and reuse of flowback was pioneered in the Marcellus, because it was like, we would rather do anything with this water locally than have to haul it to Ohio. Can we put it back down in the next hole, and will that work? And what they found was reusing that water worked just fine. In fact, there's some evidence that it actually works better to reuse water than to consume fresh water for new fracs. So that was our starting point in that market. But what we learned when we came to the Permian to create this market was, first, the biggest issue was an economic issue. Disposal remains plentiful and cheap in the Permian, unlike in the Marcellus, and there's thousands and thousands of disposal wells who want your business. And freshwater supplies in the near term, although there was a big drought through 2014, it never really got to a level where prices started to reflect a shortage. And since then, that drought's gone away, and most companies are moving toward the use of brackish and recycled water, and so there's not really a freshwater demand issue. And so economics to date has not really driven that switch over to trading and recycling. But it turned out there was a more fundamental issue blocking widespread trading and recycling of water in upstream energy, which really centers much more around concerns around both regulatory and commercial liability. And this was the surprise to me, because I thought it was all about economics, and it really wasn't. The biggest blocks to more widespread operator-to-operator recycling trade were essentially 2 things. One, regulatory liability, concern that wastewater generators have essentially permanent liability in the chain of custody, and therefore the original operator, especially if they're a big company, is always going to ultimately be held liable by the state or by the feds for a downstream spill of their waste product, even if they had nothing to do with that spill. And what happens when that water is reused by some smaller operator, comes out of their well, and then gets spilled after that? Well, maybe you still come after, Exxon, Chevron, Shell, even though it wasn't even their well that it was injected into and came out of it the well before. So that's a huge regulatory cloud that really hampered that trading market. And the lawyers in the room can speak to this better than I can, but I will say that for both Texas and New Mexico, there have been very recent state law changes that are intended to limit that liability and facilitate that trading. Whether those stand up in court and what those issues are is beyond my pay grade. The second big liability issue is commercial liability. So what we saw, and again, remember, we're in the role here as the marketplace of we're going out there shaking the trees, calling every single operator. That is all we did for years. Call every single operator and say, hey, we want to help you buy and sell your water and recycle more water and save money by doing that, or make money by doing that. You've got all this water that's just literally blowing away in the wind, sitting in these pits. We want to help you sell it. And the other big objection we got, besides the regulatory liability issue, was commercial liability, by which I mean an operator would say, hey, I don't want to have an obligation to my competitor to deliver an essential commodity for their operations, the water they need for their fracking, because I might want it for myself. I don't know what's going to happen. And if it doesn't show up for whatever reason to them, I don't want to get sued by them because they blame me for their poor planning. And so where I think come back to what Jim said, I think that what's really changing in the market today is the rise of well-financed water midstream companies with regional scale infrastructure creates essentially a credit-worthy intermediary on both sides of that buy-sell transaction that the operator on either side can say, I know if I send my water to H2O Midstream, it's gone, it's taken care of, they're going to be liable for it, and they're going to be responsible for delivering to the next guy, and I don't have to have a contract that's in between Shell and Chevron as a master service agreement, because which of us is going to take the liability when something goes wrong? Well, neither, right? And so then you get an impasse, and that agreement never gets agreed to. So I think that there are, along with the issues around standard specifications and hubs and being able to have an understanding of pricing with respect to a grade of quality, those are big issues too. We're still pretty much at the early stages of figuring those things out. And then there's the fact that we're talking about dealing on the production operation side of these companies, where lots of these companies have, really sharp marketing departments with people who are really used to buying and selling commodities and making deals. That is not what the engineers on the upstream side of the business have any knowledge or experience or comfort with. I mean, that is, ancient, or desire, that is ancient Phoenician to them. They do not want to be, making deals to trade commodities. They want a budget, they want to build things, and they want to make those things work. They do not want to be trading in that commodity. And so there is also kind of a cultural issue on the upstream side that's been, that's made it, a little bit glacial to change, but I think it is starting to change.
That's probably a good segue to you, Matt. Is water trading something that you guys talk much about? Is that a term that?
Water trading, I don't think has been thrown around as much in our space as it is in Josh's or Jim's, but it's something we've been talking about really for the last 4 years in a big aspect. As you see a flip of water going from this byproduct waste that needs to be dealt with to something that may potentially have value in certain areas for certain amounts of time, particularly in Texas more than other jurisdictions, but in some other jurisdictions as well, there's an added question of, well, who actually owns that water? It's produced with the minerals, but in Texas, water is the property of the surface estate. And at the point where it's no longer a byproduct that costs more to get rid of than it's worth, does the surface owner have a right to that produced water, and in what state, and how will it be delivered, and what if they can't handle it, and then where goes, what happens to liability? And a lot of that was what was put into the passage of the Texas Natural Resources Code, section 122.002, which is what you were referring to, which talked about ownership of produced water. And then recently we passed, or I guess this year, we passed House Bill 3246, which I had significant input on the drafting of, the changes to that statute that also really paved the way for, ownership in a trading market. It is to try and alleviate this potential liability to the industry so that we can use these more efficient and environmentally friendly practices to trade. And the same thing you saw, New Mexico House Bill 546, which I think that state views as a game changer, and hopefully it will be, because that's a state that has a water problem right now for sure.
I know you guys at Marathon put a lot of effort into working with the New Mexico people and stakeholders to get that done.
Absolutely.
Okay, so I think we'll move on to the final topic here, time permitting, or we at least go over this real quickly. I think we've heard a lot about the development of the water midstream company and the business, and I think one of the key drivers, as Jim mentioned, is developing trust and flow assurance. And I think a way to get to that point is to know what you need to build, when you need to build it, what the volumes are going to look like. So I think we'll talk a little bit about creative approaches that water midstream companies are putting in place in order to have access to production plans. What steps are they taking to get further ahead of the drill bit, further into the ground, and so that they can plan and supply demand in the future more effectively? So I think I'll start with Josh on this topic.
Thanks. Yeah, because of these acreage dedication type structures, it makes the business all about, how well can you predict what's going to happen in the future. Now, I would actually argue that your best, speaking as an economics and markets guy, I'm always making the case to these engineers out there that your best way of predicting the future is to understand what's happening in the present faster because you can never predict the future, and to be able to adapt to it more quickly. And that requires markets and hedging. So my number one answer to the question is having marketplaces and the ability to trade and hedge and having lots of sources for everything so that at some clearing price, you can always get what you need when you need it. It's just a matter of price, not a matter of quantity, whether that's water or disposal capacity or whatever it is. That's the most important thing you can have in place to make sure that your operations are not disrupted by the unexpected, right? It's being able to trade quickly, change your position, and be able to buy and sell what you need when you need it very quickly, and have liquidity in that market. And that works toward this whole water midstream model that we've all been talking about. But we're also trying to, and I think at the core of Sourcewater's mission today, as a company that's striving to show where all oil field water comes from and goes to on the surface and under it, is to try to use various data science methods and new data gathering methods to try to predict the future, at least in the near term. So some of the things we do are we analyze satellite imagery of the entire Permian Basin every 5 days to see every new well pad as it crops up and every new frac pit as it crops up and what happens to the levels and types of water in those frac pits. And the reason is that well pads typically, in the Permian at least, get built anywhere from 2 to 6 months before the drilling permits are filed. And so that helps our clients predict up to 6 months out who's going to be drilling where, and that helps them know, how much water should we be expecting from these places, or how much competition should we be expecting for water capacity from our competitors, because they're going to be drilling in these places. Same thing with, we scrape over 900 local newspapers, because before you can drill any new disposal or injection well in Texas or New Mexico, you have to put one of those little tombstone ads in the localist paper you can find to give people a chance to protest your disposal. And of course, you put it where no one's going to see it because you don't want that protest. And so there's some of these bigger companies have 2 or 3 people who do nothing but clip, little notices from the Pecos Enterprise or the, Orla Times Gazette or whatever it's called in Orla, probably best bi-weekly newspaper in Western Texas, and figure out who's drilling where. And they don't show you exactly where, they just say which county and how many miles northeast of Pecos. And so we try to map all that out every single day and say, here's what's coming down the pike. And maybe you do want to protest it, but also because disposals are the longest lead time permit in a drilling program today, it means that operators who are smart file the disposal permits and therefore file those notices way before they file the drilling permit. So it's another way to basically get ahead of the drill bit. And then the other key element is understanding better what's happening under the ground, because that gets you more long-term, right? Which is we're trying to map out and understand how much water it localized within each of these subsurface formations is going to come out when you drill wells there based on what's happening in that area. And that tells you how to size that capacity, whether you're on the producing side or on the disposing side. And likewise, you have to have that same understanding, which is almost totally absent today, for what is the capacity of the various disposal formations in any given location. And, basically what's the type curve for the disposal well? How long is it going to take for this to run out? How much water can go in there at what rate? And so that tells you that long-term plan based on looking at the geoscience of water, which is basically a new field. So that's how we try to help people get ahead.
I think that takes us through our time for today. This is Justin again.
Hey, Justin. Can I give you a 60 second? This is Jim.
Yeah, you got 50 seconds.
Very quickly. There are 3 things I think from our perspective that are really important. One is you get the best information possible through communicating with the producers, data analytics, whatever you can get. The second, you have to build optionality in your portfolio to manage change, because things change, frac schedules change, type curves change, that's storage, that's pipeline, it's multiple offtakes, multiple supply points. And the third, you've got to go all in. It's an extremely complex business. So you need effective team, back office systems, commercial folks, engineering folks that can manage all that, because it is a complex business. So Anyway, hopefully that was under 60 seconds. But those are the way, from our perspective, the three things we think are critical to get in front of and manage that kind of change.
You hit the 60-second mark, or just under it. Thanks, Jim. Impressive. I've done a lot of these webcasts or presentations on the water side. I think head and shoulders, this might be the best one I've been involved with or heard. So, one, thank you for the panelists for participating today. Incredible insight. Just really awesome opportunity to hear from industry experts. And thank you those for joining us today. We've run out of time for Q&A, but I think you'll have our information, contact information somewhere. If you don't have it, reach out to Lori. I think any of us are happy to answer questions at your convenience. And again, thanks for joining us today. Lori, if you want to close this out, I think we'll be done.
Sure. Thank you, everyone, for your participation, and I particularly want to thank Justin for pulling this all together, and our panelists. As was said, it was excellent, incredibly informative. We will have this available for replay. We will be adding it to the member section of the website, but if you want access to it sooner than that, just email me. Also, if you are planning on obtaining CLE credit, please email me, lori@eic.energy with the code, and I'll get you the certificate. So thanks so much again, and have a great rest of the week. Take care. Bye-bye.